Welcome back to Talk Tickers. This is the show where we don't just read the headlines, we rip them open to see what makes them tick.
And today we have a really interesting one.
We have a situation that I can only describe as a total paradox. So imagine this. You are a massive global financial institution. You post record fee revenue. You beat on adjusted earnings. Your total revenue is up, 7.5%?
By almost every metric, a fantastic quarter.
You are winning, and yet the market rewards you by taking your stock out back and just shooting it down over 6% in a single day.
It was brutal.
Yeah.
We were talking about State Street Corporation, ticker STT. And if you looked at your dashboard on January 16th, it was just a sea of red.
It feels like the market is in a specific kind of mood, doesn't it? It's this show me skepticism. State Street is basically the plumber for the entire global financial system. They hold the assets, they process the trades. But investors looked at this print, saw some messy numbers on the expense side, and just hit the sell button.
Immediately. The stock dropped from around $136 down to $128. That is a huge move for a custodian bank.
Right.
I mean, usually these stocks move like glaciers. This moved like a tech stock on a bad news cycle. But our mission today is to figure out if that reaction was fair.
Yeah. Was it an overreaction?
We need to strip away the noise of these restructuring charges and see if the core engine custody, private markets, digital assets is actually purring, or if the investors who sold are right and it's sputtering.
Well, I'm skeptical. Usually when a stock drops 6% on what looks like an earnings beat, it means the beat wasn't real, or the company is, hiding something in the footnotes.
So let's get into it.
Let's unpack the numbers first. The headline revenue was actually great. They brought in $3.667 billion.
Right, which was a beat by about $52 million, up 7.5% year over year.
If you just stop there, you'd think the stock would be soaring.
But you can't stop there. The controversy, and really the reason for the sell-off, is entirely in the earnings per share, the EPS.
This is a tale of two numbers, isn't it?
It is. You have the GAAP number, the generally accepted accounting principles number, which came in at $2.42. That was a huge miss. Analysts were expecting $2.79.
So a 37-cent miss. In the banking world, that's a disaster.
It is a disaster.
But then management comes out and says, wait, don't look at that number. Look at this other number we calculated.
Right, the adjusted number.
Yeah.
The non-GAAP number. If you strip out what they call notable items, the adjusted EPS was $2.97.
Which actually beat.
It beat the consensus of around $2.84. So depending on which pair of glasses you put on, they either failed miserably or did fantastic.
Okay, but I always get nervous when companies tell me to ignore notable items. It feels like accounting magic. What exactly did they spend a fortune on that caused a 37-cent miss? That's real money.
It is real money. It's about $180 million in pre-tax charges. They call it repositioning. Specifically, a $111 million charge for workforce repositioning, which is, corporate speak, for severance and layoffs.
Right.
And another $69 million for optimizing their real estate footprint.
Optimizing real estate footprint. That just means they're paying to break leases and close offices, doesn't it?
Essentially, yes.
Yeah.
They're shrinking the physical footprint and shrinking the headcount.
So they're cleaning house. But here's my issue, and maybe this is why the market freaked out. If you're paying $111 million to fire people, that suggests you were pretty bloated to begin with.
That's a fair point.
The market saw those costs and just ignored the revenue beat because they're wondering if these one-time charges are actually going to happen every single year.
That is the core tension here. Management argues these are necessary investments to become leaner. Investors are asking, when do we stop paying for the diet and start seeing the muscles? But before we get too bogged down in the accounting, I think we need to zoom out and just talk about the sheer scale of this place.
Yeah.
Because the numbers are mind-boggling.
Yeah, I saw the assets under custody number and I had to double check it.
It's staggering. Assets under custody and administration, IUCA, hit a record $53.8 trillion.
Trillion with a T.
Up 16%. And assets under management hit a record $5.665 trillion.
$53 trillion. I mean, that's not even a number. That's an abstraction. Think about that. That's more than the GDP of the United States and China combined, just sitting on their servers.
It's the entire global economy, essentially,
right,
or a massive chunk of it. And that scale, that's their moat. You don't just start a competitor to State Street in your garage.
Yeah.
You need the infrastructure to track $53 trillion without losing a penny. But what's fascinating is that despite that scale, the market is punishing them for the cost of running that machine.
Well, let's look at how they make money off that pile of cash. Because if we look at the revenue drivers, the good news column is actually pretty full. It's not like the business is shrinking.
Far from it. The core franchise is winning mandates. Fee revenue, their bread and butter, was up 7.5%. Servicing fees up 8.2%. Management fees up nearly 15%.
Even net interest income was up.
NII, yeah, up 7%.
Hold on, let's pause on net interest income. For listeners who aren't banking analysts, NII is basically the difference between what a bank earns on its assets and what it pays out on deposits. Usually, when rates start to wobble, banks struggle here. How is State Street up 7%?
Well, they expanded their net interest margin to 1.1%. Yeah, basically they're managing their balance sheet very well. But the bigger story is what they call the flywheel effect.
Flywheel. I hear this buzzword a lot. How does it apply here?
So it's the combination of two things, market levels and new business. When the S&P 500 goes up, State Street gets a raise because their fees are based on the value of the assets.
All right, that's passive growth.
But they also had $85 billion in net inflows in Q4. That's new money coming in the door. So they're getting a raise from the market, plus they're winning new clients.
So it's not just that the tide is rising, they're actually swimming faster than the other guys.
In certain areas, yes. And the area they're swimming fastest in is private markets.
I feel like every bank earnings call I read lately is obsessed with private credit and private equity. It's the flavor of the decade. But State Street seems to be putting actual numbers on the board.
They are. Servicing fees for private markets grew 12%. Is now 10% of their total servicing fees. This is the high growth pivot they've been promising.
Why is that such a big deal? I mean, why is servicing a private equity fund better than a standard ETF?
Because it's harder. It's much, much harder. If you hold a basket of Apple stock for a client, valuing it is easy. The price is on the screen. It takes a millisecond.
Sure.
If you're servicing a PE fund that owns a chain of car washes, a port in Brazil, and a stake in some tech startup, valuing that is a nightmare.
Ah, I see.
It requires complex data management, manual work, specialized tech. And because it's harder, State Street can charge much higher fees for it.
It's the difference between being a cashier and being an appraiser. One is a commodity, the other is a specialty.
Exactly. And that creates a sticky relationship. Once a private equity firm integrates with State Street's platform, they're not going to leave to save a few pennies. It's too painful to switch.
Okay, so the engine is working. Revenue is up, they're winning new business, they're growing the hot sectors. So why the long face from investors? We have to go back to the expense drag.
It all comes back to the spend. Expenses were up 12.3% on a GAAP basis. Even if you take out those notable items, the firing costs and the building closures expenses were still up 6.4%.
And revenue is up 7.5%. So the gap between revenue growth and expense growth is tiny.
It's very thin. And this is where we have to talk about operating leverage.
Yes, define that for us.
Operating leverage is the holy grail for a bank like this. It simply means your revenue grows faster than your expenses. If revenue is up 7% and expenses are up 3%, you have positive operating leverage. Your profit margins expand.
But if revenue is up 7% and expenses are up 7%,
You're just running on a treadmill. You're bigger, but you're not more profitable.
and right now, State Street is barely outpacing its costs.
Correct. And that's despite the fact that management claims they achieved $500 million in productivity savings in 2025.
This is the part that drives me crazy. If they save $500 million, why are expenses still going up? Where did the money go?
That is exactly what the market is asking. Investors are saying, if you saved $500 million, why didn't that drop to the bottom line? And the answer from management is that they're reinvesting it.
Right.
They are spending money now to build the next-gen platform.
Next gen, another corporate buzzword. But they did give us some specifics on what this money is buying. And this is where the call got interesting, because the CEO, Ron Hanley, used an analogy that I actually understood.
I like this.
He compared the current state of digital finance to the mid-1800s railroads.
It was a very vivid comparison. He said, right now, in the digital asset world, rails are being laid everywhere. Different blockchains, different protocols, different token standards. It's like the 1800s where every railroad used a different gauge track.
Right. So you couldn't take a train from New York to Chicago without unloading all the cargo and putting it on a different train halfway through.
It's inefficient. It's chaotic.
Yeah.
And State Street wants to be the connector. They want to be the standard gauge that lets the trains move between the tracks.
Which is the perfect role for a custodian bank. They are launching a digital asset platform specifically for tokenization. And to be clear, this isn't about trading Dogecoin.
No, not at all. They're talking about tokenized money market funds.
This is the boring crypto use case that is actually huge. Explain how that works for a big institution.
Okay, so imagine you're a massive hedge fund. You have $1 billion sitting in money market fund. It's yielding, say, 4%. But you need to post collateral for a trade immediately.
Okay.
Traditionally, you might have to sell the fund, wait for the cash to settle, which can take a day or two, and then move the money.
Which is slow. In finance, T+1 settlement feels like a lifetime.
Exactly. With tokenization, you take that money market fund, turn it into a digital token, and you can post it as collateral instantly, 24/7 on a blockchain.
You don't have to sell the asset, you just pledge the token. It unlocks massive liquidity.
So State Street is building the plumbing to make that happen. They want to be the vault where that token lives.
Okay, but here's the catch, and Hanley was very honest about this.
Yeah.
This is a medium-term play. This isn't driving revenue in 2026.
No, they're building the plumbing for a house that hasn't been fully built yet.
So that's the future. But they're also spending on a tech project that's happening right now, Charles River Development. This was a big acquisition for them, but the numbers looked a bit weird. Software processing fees were actually down 15%.
Yeah.
If I'm an investor, I see software fees down 15% and I panic.
You might panic, but you'd be missing the story. This is a classic tipping point scenario. They are forcing a transition from on-premise software to SaaS software as a service.
Walk us through why that hurts the revenue number today.
So in the old model on-premise, you sell a software license to a bank. They pay you a huge chunk of money up front, say $5 million. You book that revenue immediately.
Right, it's lumpy, feast or famine.
But then you don't get much money from them next year.
Yeah.
In the SaaS model, they don't pay $5 million up front. They pay you, say, $1 million a year forever to access the software via the cloud.
It's a recurring, predictable. Investors love recurring revenue.
They love it. But in the year you make the switch, you lose that big upfront check. You trade a big lump sum today for an annuity stream tomorrow.
So they're deliberately killing the old cash cow to grow the new calf.
Yes. And if you look deeper, SaaS revenue was up 7%, and annual recurring revenue, or ARR, was up 11%. They are eating a short-term hit to build a smoother, more valuable business.
It's like performing a heart transplant on the business while it's still running a marathon.
That's a great way to put it. It's painful, it's expensive, but if it works, you have a much stronger athlete.
And speaking of stronger athletes, we have to talk about AI. You can't have an earnings call in 2026 without it. They talked about agentic AI for operations. This sounds different than just using ChatGPT to write emails.
It is very different. For a company like State Street, agentic AI is where the rubber meets the road. I mean, their business is incredibly operationally intensive. They have thousands of people whose job is just to look at two spreadsheets, see the numbers don't match, figure out why, and fix it. It's called reconciliation.
It's manual, it's tedious, and humans make mistakes.
And agentic AI means AI agents that have the agency to perform tasks, not just answering questions, but logging into systems, comparing data, identifying the break, and correcting the trade.
Wow.
If they can get AI to do even 30% of that work, the cost savings are astronomical.
That is how you finally break the link between revenue growth and expense growth. That is how you get that operating leverage.
Ideally, yes. But the market is in show-me mode. They were tired of hearing about the robots coming to save the margin structure next year.
Which brings us to the guidance for 2026. And I thought this was interesting. They assumed flat equity markets for the year. That feels incredibly conservative.
It is. Management is basically saying, even if the stock market goes nowhere in 2026, we can still grow. They're guiding for fee revenue up 4 to 6% and expenses up 3 to 4%.
So there it is. Revenue 4 to 6%, expenses 3 to 4%. They are promising that positive operating leverage.
Specifically, more than 100 basis points of it. They're putting a number on it. And they plan to return about 80% of earnings to shareholders. It's a solid, steady guide. But frankly, it wasn't enough to calm the investors who were angry about the Q4 miss.
And that anger really boiled over during the Q&A. There was this moment with Mike Mayo. If you follow banking stocks, you know Mike Mayo.
Oh, yeah. He's a legendary analyst.
Yeah.
And he is not afraid to punch a CEO in the nose verbally.
He's known for being direct.
Yeah.
And he confronted the CEO, Ron Hanley. He pointed out that State Street stock has underperformed the S&P 500 for a decade, a full decade.
Yeah.
And he basically asked Hanley to explain the strategy on a cocktail napkin.
I love that visual. Give me the pitch simple enough to fit on a napkin that convinces us you guys actually know what you're doing.
It's an insult and a genuine question all wrapped into one. How did Hanley handle it?
He actually gave a pretty structured 5-point defense. We can call it the napkin defense.
Okay, walk us through the napkin.
Point 1, fundamentals. He argued the world is shifting from savings accounts to investment products. State Street rides that wave. Point 2, capabilities. They are leaders in those high-growth areas like private markets and ETFs.
Okay, those are fair points. What else?
Point 3, execution. He pointed to the recent track record of fee growth. Point 4, the team. He claimed they have the best mix of veterans and outsiders. And point 5, valuation. He basically said, we are a capital-light model trading at a massive discount, and that's unfair.
The execution discount. Management feels like they're doing the hard work, but the market isn't giving them credit because of the past.
Exactly. And Mike Mayo's response was essentially, okay, that's 5 napkins. But the underlying sentiment of the analysts remains. You've promised this tech transformation for a decade. The stock hasn't moved. Prove it before we buy the story.
That's the problem with a napkin defense. It looks great on paper or linen, but you can't deposit a napkin. The market wants clean GAAP earnings.
It really highlights the tension between the cocktail napkin vision, which is genuinely compelling, and the GAAP reality of messy charges and high expenses.
It does, and that's why 2026 is such a critical year for them. They have to prove these costs are actually investments that yield returns, not just a burden that keeps getting heavier.
All right, we've tripped the noise, we've looked at the railroad, we've analyzed the napkin. Now we have to move to the part of the show where we get a little creative.
It is time for the disclaimer. This is not financial advice. We are not financial advisors. We are just two people with microphones and a stack of earnings transcripts. Do your own research. Do not sue us if you lose money. But if you were running a hedge fund pod and you needed to pitch a wild idea to your investment committee based on this call, what is the trade?
Okay, so let's look at what I'm calling the crypto railroad arbitrage.
I love the name. Break it down for me.
Here's the thesis. The market is pricing State Street like a boring, expensive legacy bank. They see the GAAP charges, the old buildings, the underperformance, and they value it like a dinosaur. But under the hood, as we discussed, they are building the plumbing for the entire digital asset ecosystem.
Okay, so the market sees a bank, but you see a tech infrastructure play.
Exactly. So the trade is this. You go long State Street. You buy it as a safe proxy for crypto infrastructure. You get a cheap valuation, you get a solid dividend, and the safety of global custodian.
And the hedge. Because usually crypto plays are volatile.
You pair it with a short on the pure play crypto exchanges. I won't name names, but the ones that lack the regulatory trust to handle institutional tokenization.
Ooh, that is spicy. So you're betting that the big institutions, the BlackRocks, the Vanguards, when they really move into tokenization, they aren't going to trust their trillions to some startup exchange that might get subpoenaed next week.
No way.
They're going to trust State Street.
Precisely. You're betting on the grown-ups taking over the room. If State Street's digital division works, and that software tipping point is real, you get massive multiple expansion. The stock stops trading like a bank and starts trading more like a fintech infrastructure play.
Meanwhile, the pure crypto plays get squeezed out.
Exactly.
So you get the 30% margin and the dividends of a bank, but you're actually buying a call option on the tokenization of the entire financial system.
That's the logic. And if those restructuring charges finally vanish in 2026, the earnings pop could be massive. It's a way to play the crypto future without betting on the price of Bitcoin.
I like it. It's outrageous, but it makes a scary amount of sense. It assumes the railroad actually gets built, though.
That is the risk.
Yeah.
If the railroad goes nowhere, you're just left owning a bank with high expenses.
Well, that's the gamble. So, to wrap this up, State Street delivered the revenue, they delivered the mandates, they just failed the cleanliness test on expenses, and the market punished them for it.
But the battle lines are drawn. It's the vision versus the reality. And 2026 is the year they have to prove that the railroad they're building actually goes somewhere profitable.
We will be watching closely to see if they can stay on the tracks. Thanks for listening to this deep dive on Talk Tickers. Keep watching the tickers.